Imagine watching the world's wealthiest companies sprint toward a cliff, carrying $3 trillion in borrowed cash, and thinking, yeah, this seems sustainable. We are currently witnessing the largest tech giants on Earth transform from cash-rich kings into some of the most indebted entities in history, all to win an AI arms race that hasn't even finished its first lap. If you aren't paying attention to the new, complex derivatives being built to hedge this risk, you are essentially standing in a digital thunderstorm holding a metal rod. In the next few minutes, I'm going to show you exactly how the AI bubble is reviving financial tools we haven't seen trade like this in years, and why this smart money is suddenly terrified of being left naked in this market. What's up? I'm Stocks and welcome to StoxSprint. New here? One quick tap on the subscribe button will keep you in the loop. Get your friends to join the Sprint crew by sharing the video. All right, let's get to it. For a long time, big tech was considered the safe haven of the stock world. Companies with so much cash they basically acted like their own central banks. But the battle to develop the most powerful artificial intelligence has changed the math entirely. Debt investors are now sweating because these companies are borrowing at a pace that suggests they won't stop until it actually hurts. This fear is breathing new life into a corner of the market that usually stays in the shadows: credit derivatives. These are tools where banks and investors can buy protection just in case these too big to fail tech titans larder on too much debt and lose their ability to pay it back. It's a bit like buying fire insurance on a house that's currently being filled with canisters of pressurized gasoline. To give you an idea of how fast this is moving, credit derivatives tied to single companies didn't even exist for many high-grade big tech issuers just a year ago. Now, they are some of the most actively traded contracts in the entire U.S. market outside of the financial sector. Alphabet, the parent of Google, currently has contracts tied to about $895 million of debt outstanding. Meta isn't far behind, with around $687 million tied to its debt. A year ago, these numbers were effectively zero, proving that the market's complacency is starting to crack like a cheap smartphone screen. Gregory Peters from PGM Fixed Income put it perfectly when he asked if investors really want to be nakedly exposed to this hyperscaler phenomenon. Apparently, the answer is a resounding no, as the number of dealers quoting Alphabet credit default swaps, or CDS, jumped from 1 to 6 by the end of 2025. Even Amazon saw its dealer count nearly double in the same period. Watching big tech borrow this much is like watching a billionaire decide to live off credit cards just to see what happens. Why is this happening now? Activity really picked up in the fall of 2025 when the sheer scale of the debt requirements for these companies became impossible to ignore. We're looking at an environment where artificial intelligence investments are expected to cost more than $3 trillion. Much of that mountain of cash is going to be funded through debt, meaning the demand for hedging or protection is only going to grow. Morgan Stanley projects that borrowing by these hyperscalers will reach $400 billion this year alone, which is a massive jump from the $165 billion they borrowed in 2025. Alphabet itself mentioned that its capital expenditures could hit $185 billion this year, just to keep the AI build-out alive. To put that in perspective, that's enough money to buy a small country, or at least enough to make their bondholders start checking the exits. And yet, the market's appetite for this debt is almost surreal. Alphabet recently had a $32 billion debt sale that drew orders for many times that amount within just 24 hours. But here is the kicker. They successfully sold 100-year bonds. Think about that for a second. They are selling century-long debt in an industry where a company can become completely obsolete in a decade. It's the financial equivalent of a tech CEO asking you to lend them $20 and promising their great-great-grandchild will pay you back once the singularity happens. While the public debt markets are busy buying 100-year bonds, a different kind of monster is growing in the private credit sector. Between 2025 and 2028, it's projected that $800 billion in private credit capital will be needed just to finance AI data centers. This is creating an entirely new asset class that operates outside the view of traditional bond markets. These private facilities are popular because they have more flexible rules and longer distribution periods. Essentially, it allows hyperscalers to build faster without the immediate annoyance of market scrutiny. But speed and lack of scrutiny are rarely words you want to hear in the same sentence when $800 billion is on the line. The costs are also spiraling out of control. In 2025, global data center construction consumed $237 billion. An AI-optimized rack now costs nearly $3.9 million, which is triple what a conventional data center rack costs. If you're wondering why tech companies are layering multiple financing sources at once, it's because the price of admission to the AI club is becoming prohibitively expensive. We're even seeing the birth of GPU-backed debt. Startups like CoreWeave and Lambda have raised billions by using their NVIDIA hardware as collateral. We have officially reached the stage of the cycle where we are pawning computer chips to fund the dream of digital gods. Look at CoreWeave's balance sheet. As of September 2025, they carried $18.81 billion in debt against just $1.36 billion in revenue. That is a leverage profile that makes a high-stakes poker player look like a cautious librarian. This is the aggressive leverage that is now defining the AI ecosystem. So, who is actually buying the protection against this debt? Surprisingly, it's often the banks themselves. Banks that underwrite this massive debt are buying single-name CDS because these projects are happening so fast they need to hedge their own balance sheets. They are basically trying to pass the hot potato of debt to investors before it burns their hands. On the other side of the trade, some hedge funds are happy to sell this protection. Andrew Weinberg at Saba Capital argues that these big tech companies still have trillion-dollar market caps and relatively low leverage compared to the rest of the market. He thinks that even in a tail risk scenario, these giants will outperform everyone else. But not everyone is that optimistic. Traders like Rory Sandilands at Aegon see complacency and mispriced risk everywhere. He notes that the sheer volume of potential debt means these companies' credit profiles are inevitably going to come under pressure. Then there is Oracle. Oracle is the current canary in the coal mine. While rating agencies have been quiet, the market has been screaming. Oracle's 5-year CDS spreads, the cost to insure its debt, surged above 126 basis points in late 2025. Then, in February 2026, it plummeted 17% after they announced a $50 billion combined debt and equity financing plan. This shows just how violently market sentiment can swing based on a single financing announcement. It suggests that the AI financing world is evolving faster than the people whose job it is to monitor it. We are creating potential blind spots as these debt structures become increasingly complex and opaque. I want to hear from you guys in the comments. Do you think big tech is being smart by leveraging up for AI? Or are we watching a 2008-style credit bubble form in real time? Does the idea of a GPU-backed loan make you want to invest more or run for the hills? Seriously, let me know your thoughts down below. That's today's sprint done. Thank you everyone for watching. If you got value from this video, please feel free to subscribe and share the video with a loved one who may need it. I'm Stocks, and we'll see you on the next StoxSprint. Have a nice day. Wow, you're still here. You must love the channel. Take a look at this video I think you would like, or you can just watch the latest upload.